There's no worse feeling as an investor than opening up your brokerage account and seeing a position that you hold in your portfolio down dramatically, seemingly out of nowhere and with zero prior notice. I mean, what the heck could be going on? That little moment of panic is usually followed by quick navigation to the holding in question to try and uncover what might be causing this glitch. And before you pick up the phone to call your brokerage account, you notice a new message in your brokerage inbox. So you click on that, cross-read through the message, and quickly realize that the position is going through something known as a stock split. And lucky for you, in today's video we're going to be speaking about what stock splits are and how they impact stock price movements. The reason why I'm bringing this up in today's video is because I've had quite a few people reach out to me on the gram asking me why their HXQ ETF holding in particular looks like it pretty much jumped off the edge of the Grand Canyon down around 50% in one day after surpassing $100 per share. And before we get into the thick of it, I'm telling you right now that if you hold HXQ ETF or any of the other Horizons ETFs that is going through a stock split right now, you have nothing to worry about. Just like any other stock split, you have really nothing to worry about. All of this should be all adjusted in your accounts before the markets open on the 7th of July, which actually happens to be today. And since I wrote this video last night and I'm filming it in the morning of July 7th, this will probably be adjusted by the time you actually watch this video. And so now that the panic's worn off, let's actually take the opportunity to speak about stock splits and consolidations, both of which are quite commonplace actually in the world of public equity investing. And even just this past year, huge companies such as Tesla and Apple have conducted stock splits, while other companies might actually choose to consolidate shares, which is essentially the opposite of a stock split. And in really simple terms, a stock split is essentially just dividing up one current existing share in the company into multiple new shares. And this could be either 2 new shares, 5 new shares, heck, even 10 new shares, all of which depends on what the board of directors chooses to move forward with. So the next time you're reading an article stating that a company is going to be splitting their shares, say 4-to-1, well, this pretty much just means that for every current share out in circulation, there will now be 4 shares. For example, the tech company Nvidia, which has seen a parabolic price increase since March of 2020 of more than 300%, has recently just announced that they will be splitting the stock 4-to-1, meaning that if you hold one share of Nvidia before the split, well, after the stock split takes place, you'll now hold 4, each one at an adjusted price point. And you're most likely wondering, well, how does this actually impact share value? Because as we saw earlier with HXQ, it looks like the stock has been cut in half essentially, including the market value. Well, first of all, do keep in mind that when a stock split does actually take place, it will take a couple of days typically after the stock split for this to all be reflected and settled in your brokerage account, but everything will be settled adequately. But at a 4-to-1 split, it's really simple. Your loonie now becomes 4 quarters, so the number of shares increases, but the market value remains the same, right? This is not the same as, say, share dilution, where the company is issuing out more shares in the market to raise more capital, and that will actually have a material impact on shareholder value. On the day of a stock split though, the market cap of the company remains the same before trading actually commences, and then it fluctuates again as per normal. And so with this in mind, on a fundamental level, stock splits pretty much don't have any material impact on a company's value. However, they do have an impact on the way the stock is perceived by investors. And as we all know, investor emotions in this current market environment arguably have just as much importance in terms of short-term price movements as actual company performance. Even in regards to Nvidia, the upcoming stock split was announced on May 21st of this year, and since then, the stock has appreciated by another 40%, which now gives it a PE ratio of almost 100x, which happens to be well above any price to earnings that Nvidia has ever traded at in the past. But for some reason, a lot of investors get excited upon the announcement of an upcoming stock split, and this typically has an impact on short-term price movements. And then combine that with positive earnings like Nvidia just posted, well, we can see the impact firsthand. As a comparison to Nvidia though, just take a look at Tesla stock, which split 5-1 in August of 2020. During the period between the split announcement and the split actually taking place, shares appreciated by a staggering 81% and then continued piling on an additional 42% to year end, which is quite impressive. All of this to say though that companies will tend to split their stock for two main reasons. The first and main reason is simply just to lower the stock's price, and usually this will have an impact on the stock's demand because, well, now at a lower price point, it becomes a lot more accessible to a wider pool of investors. Right? Every time I speak about a stock that trades for above a couple $100 per share, let's say Amazon or Shopify, I get viewers commenting that they simply can't afford the stock. And I completely understand that because that's a substantial chunk of change for most investors. If you have, say, a $10,000 portfolio and you buy one share of Amazon, you're looking at almost 50% of your portfolio in that one single stock. Now, one could argue that fractional shares can eliminate this issue, and while there is some truth to that, well, fractional shares are not available on all brokerage platforms, especially here in Canada. So yeah, lowering the overall share price is going to have a direct impact though on the accessibility for a wider pool of investors. Interestingly, Warren Buffett has actually avoided ever splitting his company Berkshire Hathaway stock in an effort to keep the stock price closer to its true intrinsic value through avoiding having, say, hordes of less invested investors, I suppose we could say, piling into the stock and messing with its value. It's for this reason that one single share of Berkshire Hathaway stock trades for over $400,000 per share, which is absolutely remarkable. And the second reason why companies will split their stock is to boost its liquidity, meaning increasing the amount of actual shares that trade hands on any given trading day. And with a higher level of liquidity for their stock, this facilitates stock transactions and will typically reduce the bid to ask spread. In regards to the HXQ ETF, this is probably the main reason why Horizons chose to split the shares of the ETF, because it actually has a quite low liquidity, which can lead to larger bid and ask spreads, because with less trading going on, there are fewer buyers and sellers agreeing on price at any given moment. Just compare this to the liquidity of Apple stock, for example, which has an average volume of 82.6 million shares trading hands each day, and the bid to ask spread is much more narrow. So ultimately, the benefits of a stock split are actually quite minimal, and while some investors will tend to believe that stock splits have a net positive impact on price movements in the short term, well, this is usually only temporary, as the market will balance out the stock to its appropriate value after the split euphoria inevitably dies down. But obviously, companies know they are at least somewhat positive, otherwise they just would not go through the hassle of a stock split and paying for their costly expenses. Personally, I don't really care for any stock splits and I don't actually search for them. I really hope this quick video gave you a good understanding of what stock splits are though, and why when you temporarily see your account balance completely out of whack in and around a stock split, there is absolutely nothing to worry about. If you enjoyed this video, all I would ask in return is that you give it a thumbs up and let me know down in the comments what your thoughts are on stock splits. Should companies conduct stock splits, or should they just go the Buffett route and let their stock run indefinitely? I'd also recommend that you check out the links down below in the description to resources I use and recommend for new to intermediate investors, and also check out one of the 2 videos I'm overlaying right here for more information on stock market investing. So on that note, thanks a lot for watching today's video, and I will see you in the next one.